Yeah, I'll be brief, and I'm glad Samina can join. So you all can meet her as well. But recovering investment banker, if you will, and spent a lot of time here in New York, about 15 years working mostly in Latin America. Really enjoyed the experience I had down there, and working with families, governments, institutions who traditionally were not investing heavily in some of the private equity backed businesses up here in the U.S. in the oil and gas sector. For a variety of reasons, including structure and tax, that just made real asset investments onerous for them. So part of our direct investment idea was to build something more efficient for foreign capital, and of course, approaching the U.S. family office market primarily as well. Samina and I started working on this back in about 2014-15. Got a small mineral transaction done going into COVID, and for a bit there, nobody really wanted to talk about oil and gas, et cetera. So we're now out in the market with this transaction we'll talk about today. And with that, I'm going to let Samina introduce herself, and you should be able, Samina, to bring up the slide, no problem, with the deck, no problem, once you've said hello.
Hi. So yeah, I'm Greg's partner in Energy Finance Partners and the founder of Lower 48 Analytics. Since the time is rather brief, I'd like to share with you what we're working on right now, which we think is a very a good source of alpha that really capitalizes on the fact that upstream oil and gas is at the moment is undercapitalized in the U.S. So there's a very natural entry point into the opportunity. So I'm going to go ahead and share my screen, if I may. Can you see my screen?
Yep.
Great. So I'm going to try doing it full screen because it's a little. We've identified, as we said, an opportunity for low risk, high upside investment thesis. As is our normal model, when we identify a thesis, we look for an experienced management team to partner with to execute on that thesis, to make sure that all the basic building blocks are handled by a best-in-class partner. And we have, you can't really say that tax technology is proprietary. However, we have a proved model to structure for tax efficiency for overseas investors. We first deployed it in a mineral rights strategy where we partnered with OneMap as the acquisition partner. Well, let me see if. Okay, so why is this available right now? In a word, 3 letters, ESG. The focus on ESG has meant that capital has been misallocated, in our opinion, with upstream companies being starved to some extent of capital, and being in a position where instead of maximizing high return investments, they're doing things like paying out large dividends, repurchasing stock, etc. We think that oil and gas is in our vital national interest, and we're happy to be able to actually do well by doing good. So if you look at the upstream investment life cycle, there's sort of and here we're really focusing on the really the horizontal drilling and fracking, which has revolutionized really the space in the lower 48. It's been a technological triumph, really, that's perhaps underappreciated. But if you think about the steps, there is a preliminary step where you're not really discovering deposits, but you're discovering the ability to access deposits. And there, you've got a land grab mentality. It should be financed on balance sheet. It should be financed with equity, though it always wasn't. And then once you've discovered and proved that you can access, then you start your drilling, and you have. Can everybody hear me all right?
Yeah, we hear you. Yes.
Okay. A little bit of background noise. So anyway, No worries. So once you've proven out your deposits, then you're in a development drilling. You're doing infill drilling. You're drilling proved reserves, and that's the highest and quickest value up a step up in this in the upstream life cycle. Um, if you think about the value of an asset as the present discounted present value of cash flows, when you put a drill bit in the ground and start extracting those proved reserves, you have a very quick return of capital, but you also have a uh, substantial reduction in your implicit discount rate, hence a very steep value creation step up. Now, once if you could isolate that activity and say, okay, now I have a portfolio of wells that have all been producing for 48 months or more. Now you have an asset that is separately monetizable and has in fact been securitized. So we're playing in this middle step. So what are we buying? We're buying non-operated working interests. Those are well by well or pad by pad partnerships in operating wells. The ability to participate in wells as a non-operator is a technology that's been around for 100 years. All the legal mechanisms are well understood, and it really lets you come in alongside a best-in-class operator in a best-in-class basin and create a diversified portfolio by building up from bottom up from your wells. Now, to remind ourselves of the value stack of a flowing barrel, for ease of illustration, we're using $100 oil here. Once a barrel is flowing out of the ground, how does its value get split up? Well, first thing you have to do, unfortunately, is pay your $8 in this example to the state of Texas. You've got to pay to produce, and with some corporate overhead, so that's $10.50. You have to pay the minerals owner, the guy who let you lease his acreage and drill and extract. You have to pay him a fixed percentage, agreed upon percentage of the barrel. And then you've got the EBITDA. As a working interest owner, you share in your proportional share of the EBITDA. You may be familiar with minerals. As a minerals owner, you share in that cut of the barrel that the operator owes you contractually. So here's where we're playing. Now, why is this available? That's really and we'll skip to this. That's really an artifact almost of the way that the top basins in the U.S. were developed. Really, starting back in 2011, you started having operators coming into basins like the Permian and essentially saying, we think we know how to extract the oil from the rock. Now, at the time, operators felt they were diversifying risk by participating in each other's leases. So you might have Cimarex with a lease and EOG with a lease next door, and they would take 10% interest in each other's leases with the thought that they were diversifying risk, reducing risk and diversifying geographically. Well, fast forward to really after 2014, operators started noticing that really they were drilling, they had proved out the reserves. There really isn't any more risk perception, but there's still this mosaic of cross holdings. Now, in 2019, operators started ramping up this infill drilling, and that's fine. That was the right thing to do. But then coming up with the whole ESG phenomenon, every operator loves to tell his shareholders and his lenders that I'm in perfect control of my CapEx budget. I know exactly what I'm going to do. I'm in control. Well, the one thing they're not in control of is the other guy's CapEx budget. So as all the operators are ramping up drilling, a non-operator gets 30 days, sometimes 2 weeks notice. All right, here's the well, I'm drilling this next well. Here's my costs. Here's exactly where it is. It's going to cost, I don't know, $10 million. You got a 10% share. you owe me $1 million, are you in or are you out? Now that $1 million investment could have an IRR, both the buyer and the seller know this, have an IRR of 60%. So it's not that it's a bad investment, but it's the fact that you've got this capital constraint phenomenon. So what does the non-op do? He can say no, in which case the operator takes his share and doesn't give the non-op any money until he's recovered usually twice the investment. Or the non-op would like somebody like us to come along and pay him something to step into his shoes. Now, in terms of the scale of the opportunity, based on anticipated drilling of about 77 billion this year in the basin that we're focused on, you're looking at about a $7.7 billion sort of opportunity set for us to to play in. So, as the EIA would tell us, tight oil, so the basins we're addressing, Anadarko, Bakken, the top regions, are going to account for the lion's share of oil production in the United States for the foreseeable future. Okay, so we have the opportunity to build a diversified asset level investment portfolio with high quality operators. We have robust single well economics that we do. And we put together tax efficient structures all around an experienced leadership team with a proven track record, existing on the ground presence and reputation, and a backlog. So what's the edge here? It's a set of relationships that are underpinned by the ability to provide prompt and disciplined financial bids to execute on the purchases. So we structure, as we said, appropriate investment vehicles for investors. There's we have proven tax efficient structures with best in class service providers. And our Lower 48 analytics system is a SaaS upstream portfolio management system that allows us to have perfect transparency and perfect control over our investments. And that's something actually, to the extent investors want to be able to drill down to the single well level in the portfolio, we can do so. So we won't spend very much time on the tax. We have some graphics that I think make the point a little more succinctly, but we have a continuous investment process that builds up a strong database of information. Because remember, every time you participate in a well, the operator owes you granular daily production and cost data, and that information feeds your next investment decision. And so that virtuous cycle makes you better and more prompt on bidding.
Samina, we've got a question here.
So is the investment in the fund or in individual wells?
The fund aggregates capital, and we invest in a portfolio of wells.
So you invest in a portfolio,
Yeah.
and you get all the tax. It's a pass through to the
absolutely the IDCs, intangible drilling costs for the U.S. partners, if you will, US LPs, gets passed through to them, and then we can talk for anybody that's got a non-US reality.
And the wells that the wells that you're investing in are already existing wells, not new ones.
These are new.
These are all new wells. In fact,
these are all new wells in proven fields.
Yes, exactly.
Yeah, because IDCs only work for new wells.
Yeah.
Yeah. So let me. Here's an example.
I got a question. So, number one, go back to the chart and show barrel and barrel and tell me exactly what the number is staying in. So $40.
Okay, wait, sorry. I'm sorry. Go back to the chart.
Go back to the flowing barrel. The barrel.
$42. It's going to cost you $60. We did not blow that out. So it's basically $40, and you're taking a piece of it.
Okay, so when we so if we've got if we're working with $70 oil,
$100 oil.
Well, yeah, let's just use the $100 example here.
Okay, sorry. Okay, so I'm sorry. I thought the question was okay. So what we have. So barrel comes out of the ground. This is after we've drilled it. Obviously, when we analyze the returns, we put in the drilling cost as the upfront cost, and then we generate the cash flows, right? And so, in general, actually in order of priority, you owe the state of Texas your severance and ad valorem taxes. You can't
Yeah,
get away.
I just get to the point. What are your purchase date? At dawn?
Ultimately, what we're getting is a portion, a pro rata portion, given the percentage
Yeah, of
interest.
the
in the-
EBITDA. Of the-
Yeah, of EBITDA.
So the bottom line is $100 barrel, it cost you through all the payment structure, $60.
$40.
No, $40, and we get 60. I mean,
Get
yeah,
60.
that's basically well
Yeah,
economics
and then,
101.
yeah, and then the question just
Yeah.
becomes, sorry, this thing is thwarting me. I'm gonna get out of,
Okay, the next question is, when you talk a little bit about diversification, how many different spots are part of this fund? In other words, what are the number of parts of geography in the United States?
let me address that actually by also focusing you a little bit on this, on.
Just let him finish his question, Samina.
But-
Let him
but,
finish his question.
Yes, I heard the question. So,
The question is,
so-
how many different pieces of real estate are you looking at when you're looking at drills that are new? And what areas do you avoid?
we look at, well, it depends on how granular you want to get, right? Each one of these wells is in a highly specific place, and we analyze it. We get its latitude and its longitude, its exact location, its exact cost, et cetera. Now, in terms of basins, if that's your question, we look at all of them. In other words, we look at all the top tier basins, so the Permian, both the Midland and the Delaware. We look at the Anadarko, we look at the Bakken, Eagle Ford, DJ Basin in Colorado. Those the Haynesville. Those are the main ones. Now, having said that, we don't diversify to diversify. We look at each well opportunity on. Well, our engineer does a production projection for that specific well, and we look at the economics, including a very granular production and transportation costs and then we bid a price that generates based on that cost, we bid a price to the non-op. We pay him to go away, and we bid a price that when we put in what we're paying him plus the drilling costs, it gives us our target IRR. Now, having said that,
What happens if the government opens up more property for lease drill? How does that economics affect?
we don't, we're not buying property. We're buying,
Buy wells.
we're buying the
I mean, more
well.
wells to
only
be drilled.
Yeah, so but what we do is we say we're buying just the wells that you've already gotten an authorization for expenditure. An authorization for expenditure, basically, I don't know if you can read this, but one of these lines is one of them. So it tells you exactly where it is, what it's called, its latitude, its longitude, its American Petroleum Institute number, its very granular costs. So so each one of these gets analyzed, and we can have, we might bid on 50 of them, and we'll probably win the ones we bid on, but we might turn down a whole bunch. So for instance, right now, some of these basins, once you do the analytics, you conclude that you don't want to bid on them, depending on, so it could be, for instance, that in the Bakken, for instance, anything that's natural gas heavy, you're not going to, the economics won't work because the transportation costs are huge for natural gas. Whereas in the Eagle Ford, there is no transportation issue, and so the economics are very good. So it's very, very, very bottom up. I don't know if that answers your question. And then someplace like Colorado.
Oh, yeah. There was a question about competition. We've not seen people out in the market aggregating these smaller interests. There's people going out and buying big single asset non-op positions. PE funds still do that to a degree. Drill cos, where they go in and provide drilling capital and or buy a big asset. So we've not really seen somebody doing this in a granular way, which we think is the best way, given again, diversification, et cetera. So you're going to either bet on a team and an operator if you're going to buy one big asset.
Yeah,
But we do see co-investment opportunities where we like an asset. In the Haynesville, we've probably underwritten, if you will. The team is looking at about $750 million as we're setting all this up of opportunities that we would have pursued or could have pursued. And in that time, probably a half a dozen $50 to $100 million assets where there would be a co-investment if we chose to move forward, because the fund would never take a piece that big.
Is there any institutional money now?
You know what?
Institutional money?
No, at the moment, no. We've been more focused on the foreign capital that I sort of, if you will, came up in business with, and family, single multifamily office.
The thing is,
We're headquartered in Austin, and we talk to all of the TRS. We know the energy team there. They love this strategy, and their comment is raise $1 billion, and we'll give you $250 million. You got to be $1 billion so we can give you 25%, and that's $1 million of spend on everything that we need to do for an investor like that to hopefully get a yes. So we'll get there. We think this is going to be a good institutional product, but I'm not going to tell you we're talking to a lot of institutions.
yeah, we've.
I worked in the. Go ahead, Bassoon.
I was going to say, we're focused very much on having a product that, in a sense, the analysis is homogeneous, but the actual opportunities are granular and diversified, and we can build them up. With a process, we can build out that diversified portfolio, fairly quick. As you see, I mean, if you have $7 billion of opportunity, you can pick out a good portfolio without too mumuch strain. But the other thing I would say is that versus buying one big, non-op opportunity with a single operator, here we only invest when the drill bit's about to go in the ground. So we don't have any uncertainty as to when the guy's going to get around to drilling or whatever. That's sort of the beauty of the amount of information that you can get about individual wells and individual locations in proved basins. You eliminate all
So go ahead.
Yeah, but what do you do? Like this has happened to me where you're drilling according to the plan, you hit the zone and it's not prolific. So the op says, okay, now we're going to drill another 1,000 feet. You want to play or not play? In my case, I said, forget it. I'll write off the investment I made. Have you been to that movie? Hopefully not, but I have.
No, that's a movie that happens. That yes, has happened a great deal. But remember, we are only we're looking at every single opportunity. So we're not going and saying, "Here's money, go do something." And we are only we're participating only in places where we think it's proved reserves, and with as with very, very specific permitted wells with the exact horizontal distance, the exact depth, the exact long. So this is not in any way exploratory. This is, and also, for anything that we're shown, if we have uncertainty, we just don't bid on it. We have plenty of other things we can do.
Given the projected size of the fund, how many opportunities do you invest in?
Basically, the average well participation is going to be somewhere between, as you can even see in this backlog, between $50,000 and $2 million in general. So you almost your average well costs $10 million, and on average you get to do 10% of it. So you can sort of do the math.
So it's a diversified portfolio.
Yes, I mean we feel pretty confident. We've got $100 million. We think of good conversations happening. We've had a very small first close with some oil and gas families in Texas just to get kind of up and running. About $25 million of very visible capital in January, waiting for the new year, and so at about $100 million, figure 75 to 150 assets. Okay.
Yeah. Well, yeah. So in fact,
roughly.
Yeah. So what we did was.
Is there opportunity for co-investment on this thing?
That's what I was mentioning a minute ago. So we've looked at it, and we've got a separate deck we can send that just talks to the backlog, and we update it probably once every couple of months. And there's 4 or 5 co-investment examples in there that we've looked at how that would work. And so I used the Haynesville, about an $80 million deal, and we would size that accordingly in the fund, and whether it's a non-U.S. or U.S. investor, it very quickly dropped down a SPV to
But that
manage
$80 million deal just happened to be a list of wells that were about to be drilled.
Yeah.
So so it wasn't that there was like one $80 million well. I mean, obviously there wouldn't be.
Exactly. It was a package that was going to just require more capital than the fund would ever allocate to, given our strategy, but it definitely co-investment opportunities often.
So if I can just jump ahead to just showing you, because what we did was we went through the backlog as it was, and we identified which of these wells we identified the ones we would put in the portfolio. And so now how do we do that? We do it in a rather disciplined way. We look at each well and we say, okay, we're going to assume that there's going to be a 10% cost overrun on drilling and completion. And then we're going to look at the expected IRR of the well, and then we're going to assume that the non-op is not just going to gift us the opportunity. We have to pay him something. So we'll pay him enough to bring our IRR down to around 30%. So basically what you're really telling him is, look, I'm paying you your cost of equity capital. And so now once we step into the non-op's shoes, we are completely aligned with the operator. The operators are always boasting of their ability to bring down the cost curve, to be efficient, etc. So we are completely aligned, which is a good thing. But anyway, doing all that, we built a sample portfolio, which at the time was this is to the diversification point, 94% Permian, 2% Bakken, 4% Anadarko. That grouping was really built from the bottom up. Given the pipeline or lack thereof situation in the Bakken, the economics were not as attractive. And so now in terms of the upfront payments we're making to the various non-ops were between 10% and 70% of AFEs, 35% on average. So if on the average well costs $1 million, over and above that, you pay $350,000 to the non-op to sell you his interest. Again, that's a bottom-up analysis. And so that portfolio had an expected IRR of 28%, assuming every operator has a 10% cost overruns. And
2 minutes.
Yeah.
And okay, so 2 minutes. Okay. So anyway, so bottom line is here's a sample cash flow so you can see that you start cash flowing, within 6 months of the drilling. And you've got very heavily front-end loaded cash flows. Obviously, they go on, for 20 years. You've got a 28% IRR, 30 months to return of capital. And most of your production comes in the front months when your your commodity prices are most visible. And I won't bore the structural schematic, but I will. But I do want to show you sort of how the onshore payout metrics look. And here what we did is we broke out the cash flows from this portfolio. Remember the 20 pre-fees. As you can see, we have an immediate tax shelter of about 80% of the drilling completion costs. And that tax shelter gets chewed up by sheltering the income. Once that's used up, you start having to pay taxes, unfortunately. And then you have, you monetize the portfolio at the end of 4 to 5 years. And there's a ready market for portfolios of established producing wells. So that's basically it. And we have a lot of data on how we do this and examples of a negotiated purchase. We also have we have obviously our track record and perpetuals. And we actually have a track record for our first comparable strategy, put our overseas technology on top of a mineral strategy. And I should comment that in terms of competition, since that's something that was raised, this is a less crowded space than the mineral space, and to our mind, a lot less risky because you're dealing with disciplined sellers. They're selling for a reason, and which is their own capital planning, and you've got no timing uncertainty as to when your money's going to get deployed.
Yeah, mineral. We like the mineral trade that we did. We had, you identified the opportunity and then the right team, which is our business. And it's the mineral space is just insanely heated up, crazy money being thrown at it. And again, when you buy minerals, we think there's a lot of downside protection in owning minerals if you buy them right, but you're waiting around for somebody to make a decision to drill or come along and lease them, et cetera. Here, again, we're within weeks of capital deployment and the drill bit going in the ground. So we've got data room, lots of other information. I'm here today and tomorrow and we'll probably be in California. Some of you will be there, but we really look forward to telling you more about what we're doing. And thanks, Marty.
One of the best recent investments has been a coal mine, and it's the same counter ESG play. So I don't know the specifics of your play, but I mean, counter ESG, makes sense in my economic mind.
Yeah, and we would love to talk more about that, and the reason some of them laid out here as to why that's creating, issues for these non-op owners, even these operating companies that have non-op positions or selling, et cetera, people getting it off their books. So,
Yeah, I think it's the counter ESG theme has actually worked for a couple of years now. So although we like ESG, but we like counter ESG too.
They're-
It's a barbell approach. All sides of our mind.
Yeah, let's
So
not-
we have the ability to contemplate all, right? So great job. Thanks so much, Ben.
Thanks.
Great. Thanks, all. Bye-bye.